What's up, guys? Welcome to another episode of What Not to Do Wednesday. So let's talk about your debt to income ratio. If you have a really high debt to income ratio, there's no sense in applying for a loan. Let's face it, you don't need the hard inquiries on your credit. It costs me $35 every time I pull a credit report. It's just not a good thing all the way around. So let's talk through the debt to income ratio real quick. Most mortgages, textbook answer, is about 45% debt. So you don't want your total debts to be more than 45% of your income. Now, lenders, we look at your gross income before taxes and everything you're taking out, any adjustments. We're looking at your gross income if you're a salaried employee, okay? And we're going to take all your debts that's pulled off the credit report, plus the new house, of course, and then we're going to divide that by your income. Doesn't need to be much more than 45%. If you're doing a government loan like an FHA loan or VA loan, they allow for a little bit higher debt to income ratio, but let's just stick to the textbook. So if you've got a bunch of student loans, you got a car loan, you got credit cards coming out all over the place, and you know that your debt to income ratio is really high, or you've got a wife that works, a spouse that doesn't work, but you want her on the loan and she's got a lot of debts too, that's probably not going to work out. So know your debt to income ratio before you go into getting a loan. They say nowadays that's one of the top reasons why people don't qualify for a mortgage. Besides not having adequate credit, is having a really high debt to income ratio. Most of the times, I see it now because of student loans. So just know it going into it. It's a super simple calculation that anybody can do at home with a simple calculator and a pencil and a piece of paper, or if you're really fancy, get out an Excel spreadsheet and you can calculate your own debt to income ratio.